And then later on we find that they're locked in this channel where they're being substituted back and forth again for each other. And eventually soybean takes dominance and corn gets sold off immediately. Very interesting interrelationship. And it's good to be able to understand what hedgers are buying corn, what hedgers can substitute corn, and just kind of play off of one another, because you can basically say you can put on a soybean corn spread, and when corn is up, soybeans are down, or they're not up as much. A lot of opportunities to trade these substitute good products. Here's another great example in which we see support channels, minor support and resistance channels happening in two livestock products. In the red we have live cattle, and in the blue we have live hogs. In the live cattle, for a long period, there was just no activity, no movement. You had approximately 4, 5, 6 months from March pretty much to August time period in which there really wasn't a lot of aggressive movement. And the same was reflected in the live hog chart as well. But when mad cow disease was discovered in mid-July in Canada, we start to see an uptrend form in the live cattle contract, and we start seeing the price being driven up. There's no activity in the live hog, and in the later stages, the live hog starts to actually descend in value because people are buying less hog and buying more cattle. But there's a point when we look at the blue circle and the red circle, in which live hog starts to make a comeback. It drives to a new, it drives up to a new point, trying to break the downtrend line, and we see the live cattle reaching an all-time new low. Later on, we did actually see live hog develop a lot of strength and start to show up the live cattle. But these are two substitute products. When cattle is having all types of problems, people like to buy little grocery stores and people who make promotions for different food, major food manufacturers such as Burger King or McDonald's. They start bringing out barbecue sandwiches, pork barbecue sandwiches, and all these kind of items to substitute the beef problem that they're having, because just beef's too expensive. So these two products are substituted, and it kind of gives you some indicator of what's happening in the other market, and there's opportunities to trade. Which leads us into overbought and oversold. Now that we have an idea of what's going on with the support and resistance and how hedgers have reached points where they're content with buying with particular prices, or they're discontent with buying particular prices, and sellers are content or not content depending on the support and resistance levels, we have to look that these major hedging firms cannot just throw themselves in the market. They have to bring themselves in at varying intervals, and they stop bringing themselves into the market when the market moves too far, too fast. And this is where overbought, oversold indicators become important. Now, since futures play off of actual goods that will be bought, transformed, and manufactured into finished products, there are minimums and maximums that the sellers are willing to pay at that time for their hedging. And so they have a Treasury Department who's watching and making sure that they're not going to overhedge in the marketplace and how the hedge is just not going to be effective. And this all ties back into the cash price versus the futures price and basis. This all plays into the same view of the market. And so overbought, oversold indicators are extremely relevant in determining whether or not the market can bear the new price, and whether or not hedgers are going to first sell out their positions in order to find lower prices in order to continue their hedge up. And here's a few charts discussing overbought and oversold. Now, there's three indicators that we like to talk about in our company for overbought and oversold. First is the relative strength index, and we like various types of price envelope bands. In the last 3 or 4 years, I discovered Bollinger Bands, and I would definitely like to use them because they really reflect the level of movement and volatility going on in the market. And there's something also called Williams percent R, which is really effective in the futures market. I also believe it has a stock component as well. Now, the first two indicators that we like to use working together are the relative strength index and the price envelope bands, or the Bollinger Bands. Both represent overbought, oversold conditions, but separately they tend to give off a lot of false or early signals. Typically, technical analysts believe that RSI values can range from 1 to 100, and if they're valued at 30 or less, that represents an oversold condition, and if it's valued at 70 or more, it represents an overbought condition. And that's good to be able to see, but sometimes you need an extra indicator to help confirm whether or not this is the case. And so we tie ours with the Bollinger Bands. The Bollinger Bands just represent a price envelope bands that first follow the moving average and then put a standard deviation of plus or minus 5% either way. And what makes Bollinger Bands unique is they adjust the level of volatility that is going on at that time in the market. So it really shows who's buying or when the buying is happening or when the selling is happening, and you adjust the bands accordingly so that you can really see when you should be entering. Again, Bollinger Bands are not infallible, and they can create false and early signals. So using them together tends to work best in creating a tandem scenario. Now, we'll show you some slides from time to time where we look at the Bollinger Bands by themselves and then compare that with the RSI, the Relative Strength Index. And it really comes down to the type of trader that you are, and again, goes back to the trade management tools we discussed, of developing your own style and developing your own trading plan that works for you. Now, we look at this Bollinger Band on gold. Gold, definitely an up market. You know, we look here, the trend line is definitely up. But we look at also opportunities to sell into this uptrend. And I've circled in green the various opportunities that the Bollinger Band shows us the market is overbought. But in the 9 different opportunities here to sell the market, we end up with 5 of these opportunities being early or false entry signals. Now, again, we haven't gotten deep into the numbers, but when I say false or early signals, sometimes the market did do a turnaround. It shorted. It was an overbought signal that was valid. But usually, it took 4, 5, 6, maybe 7 different days for it to actually make that turnaround. And sometimes it actually spiked higher. And if you use strong trade management tools to determine your trading, oftentimes those spikes higher before it actually goes down would have hurt you because you would have been stopped out of the market. So the Bollinger Bands by themselves can create these false signals. Now here's the same gold chart in which we use the Relative Strength Index and the Bollinger Band together. These same 5 false signals appear, and when we look down at the RSI, only 2 of the RSIs, only 2 signals pop up on the RSI. Out of all 9 of these signals showed up on the Bollinger Bands. In both times that the RSI shows up, we do see a significant drop in the price. But it comes down to your trading style. When you look at trying to confirm these 2 together, you see that the RSI in the first instance showed a fall in mid-May, and in the second instance didn't show a dipping point again until January of 2004. So making 2 trades in an entire year may not be for you. So using strong money management techniques, you could reconfirm with the RSI, and you could still take advantage of the Bollinger Bands, but just make sure that you realize that not every time you take a Bollinger Band, it's going to be a successful trade for you. Here we have the Bollinger Bands again by themselves, and this is an example of a live hog chart, March 2004. And we look at some of the oversold signals that occurred on this chart. And out of the 7 times that the chart showed that the Bollinger Band showed that the live hog was oversold, there were 3 times, almost 50%, in which the oversold indicator was ahead of the curve or just was a false or early signal. So you've got to temper how you trade. Now this is the same chart, live hogs, with the RSIs. And of the 7 signals, we have 4 being confirmed with the Bollinger Bands. All of them working out fairly well at being oversold and doing turnarounds and moving up. So you have to kind of look at how you trade the Bollinger Bands and overbought and oversold indicators and figure out what works for you. Because sometimes 4 trades in a, I don't know, year, practically an 8-month period is just not strong enough. But it depends. If you're holding on to a trade and you decide to only enter or buy another contract based on the next time the signal pops up, there's opportunities to pyramid and build up your positions. because you also have leverage on your side in futures, unlike many other trade.